Welcome to the Alternative Investment Podcast. I'm your host, Andy Hagens, and today we're talking about structured credit, a very popular asset class, increasingly popular, I should say. And I'm very happy to announce that joining me today is Colin McBurnette, who's Senior Portfolio Manager at Angel Oak Capital Advisors. Colin, welcome to the show.
Thank you, Andy. Nice to be here.
And we have a lot to talk about today. Structured credit, I mean, it's huge in alts. I mean, it's increasingly a part of high net worth investor portfolios. And we also want to talk about the macro picture a little bit, but why don't we start with you and your background and what you do at Angel Oak?
Sure. I'm the Senior Portfolio Manager here at Angel Oak Capital Advisors, based in Atlanta. I oversee all the residential mortgage credit investing that we do within our public funds complex, as well as within our separately managed account business and our hedge fund. Prior to Angel Oak, I was at Wachovia, working in their CMBS group in the pre-crisis period or pre-global financial crisis period, and then spent a few years in a distressed debt startup in Atlanta before joining Angel Oak in 2012.
So let's see, you've been in this kind of credit world since before the financial crisis. Would you say how many market cycles? I guess let's time them not in years. How many total credit market cycles have you been through?
Sure, well, we're coming on 16 years now, but I guess it would depend on what would how you would define a cycle. March 2020 on its own, felt like we lived the full cycle from peak to trough in a couple of week period. So everything, heading up into the global financial crisis period through, and maybe we define the start of QE as the beginning of a cycle, and quantitative easing as the official, or quantitative tightening, excuse me, as the official end of that one. So here we are, kind of heading towards what is realistically the first, potential recession that the U.S. has faced since the global financial crisis.
Yeah, and it's interesting. You kind of alluded to this. How do we even define a cycle? Because to your point, it felt like 2020 was almost a 1 year cycle, the whole cycle in a year. There was the financial crisis, 2008, 2009. And to me, though, it almost feels like the macro cycle in credit and in inflation, it's arguably like 40 years or something. Like in terms of, if I really zoom out, I could say we've been deflationary for so long that even having a year or two of sustained higher inflation, it's like, I'm 39. I'm like, I don't have the muscle memory to deal with this, right? I wasn't around in the 70s.
Well, most people sitting in the seat today making decisions have never, especially in fixed income, have never traded through or managed money through a sustained bond bear market. And we got that in 2022 for the first time in most of our careers.
An interesting thing, to stay on inflation for a second and interest rates. So I have like two theories that are in tension inside me right now on inflation. And the one theory is there are structural issues in our economy right now that point to higher inflation sticking around. Supply chain, tightness in the labor market, just structural things that I don't think have gone away. I know we're seeing disinflation starting to set in, and I think that will play out. But personally, I don't really see disinflation, like things going back to the way they are. Like that's kind of the near term, midterm picture. But I also see there's all these longer term trends that are deflationary, in terms of demographic trends, in terms of, I don't think globalization is going to totally reverse itself, innovation, technological efficiency. So it's like, even in myself, I can't decide which of these two kind of big picture things, these structural issues causing inflation to sustain, or the really zoomed out kind of long-term thinking. I still feel like things are deflationary when I really zoom out far enough. What do you think?
We've had that debate a lot over the past few years. Heading into, let's say, through 2019, I mean, there were a number of things you could point to that were particularly disinflationary, as you highlighted, demographic trends in the U.S., slowing birth rates, things of that nature. But I think one of the trends that's emerged and shifted our thinking towards us being in, call it a decade-long inflationary environment. And that's not to say that we won't, get some benefit from the data this year and and roll back towards the Fed's goal, perhaps giving them, justification to take their foot off the gas pedal here. But we do think that number starts to trend higher again. And a big component of that is the labor force dynamics that exist, especially with the conflict that we have now in Europe, and kind of the whether it's both changing demographics abroad as well as somewhat of a shutting off of the West from from the labor force that had existed in Asia and in Russia over the past several decades. I think it's going to have a pretty big impact on cost of labor and ultimately cost of goods, and have a very inflationary impact on its own. Additionally, if you go back to the 1970s, you had the largest generation in history in the form of the baby boomers come home from the war in Vietnam, and then really start to kind of get down to it, if you will. That they began forming households at at rapid pace. They hit the kind of peak years when you tend to get into that time in your life when you start buying a house. You tend to be on an upward slope from an earnings perspective. You start adding leverage, typically in the form of a mortgage, but also in credit cards and other ways. And that tends to have a very stimulative inflationary impact on the economy. And you could draw a lot of corollaries to what we saw from a demographics perspective then to what we're seeing now, with the millennial generation effectively kind of coming home from the war on COVID, if you will, entering that very same part of their lives. They are the largest generation to come through this part of the curve. They're larger than the baby boomers. And you've got the leading edge of Gen Z not far behind them. And they're projected to be slightly larger, or at least as large. And so I feel like you're going to push a lot, a very large portion of the population through those kind of peak years for formation and productivity and leverage over the next 2 decades. And that, I think, is going to have a pretty inflationary impact in terms of what it does to the U.S. growth picture.
Well, that's really interesting. And to your point, to me, the demographic thing, again, it matters how far do you zoom out, I suppose. And I've heard that story, with millennials, the largest wealth transfer in history, coming of age, household formation. Sounds like Gen Z might be even bigger. But one piece of this I don't understand is, okay, the birth rate is 1.6, but I keep hearing each generation is bigger than the last. I'm like, well, how is that possible? Is it the case that, there's like a 30-year lag or 40-year lag between the birth rate and this household formation that's happening when millennials are in their 30s? Or is it more that immigration is filling in the gap, a lot of good ways economically, right? So part of me feels like maybe this comes down to immigration. If you look at the country's population, fast forward the next 100 years.
Yeah, there is definitely a lag from the birth rate to its impact, and that's definitely something that's notable. I think right now, the immigration environment in the U.S. is such that we're not bringing in anywhere near as many people as we used to. And by some economists argue nowhere near enough to make up for that decline in birth rate. And that does have, a shrinking population is a definition for a slowdown in growth. And, that could create, whether it's a Japan effect over time, it's definitely something that we're watching, though that is, to your point, incredibly long-term. And you've got to zoom pretty far out to be, I think, focused on that impact. And as long-term investors, we're something that we clearly think about. But I would say that our focus from an investment perspective tends to be, much more near sight.
Let's let the endowment portfolio managers worry about demographic trends 100 years ago, right? Like for you, for me, for a listener, for an advisor, it's really the next 30 years. I guess we can call that long-term. We'll call it it's not very long-term, but we'll call it long-term. And on that note, so it sounds like in general, I'm hearing Angel Oak, you all believe that this higher inflation is going to stick around, right? And there may be some disinflation, but we're probably not going to get back to, 2% long run inflation target indefinitely. Is that fair to say?
We think we'll touch it, but we don't think we stay there.
Understood. So on that note, I downloaded your 2023 market outlook, and there was a lot of interesting stuff in there. One section that really popped out at me, and it made the CMO in me smile. I'm a marketing guy. Are bonds the new stocks, 60-40 to 40-60? And I just smiled because I'm like, this is the gauntlet being thrown down. So let's talk about this. This is a really big picture idea that the 60-40 is now 40-60. What do you mean by this?
Sure. With rates having, with that 40 plus year bull market for rates that you defined out of the gates. And then, with where rates were in the post, global financial or certainly post QE period, if you wanted high risk premium stocks were the place to go get, excess return and be able to keep up with whether it was spending goals on the endowment side or saving for retirement and trying to achieve some goal. You tended to have a relatively large allocation for stocks, and stocks certainly benefited handsomely from the lower rate environment. But when we were assessing the landscape looking forward after last year's bond bear market, you got to the place where in high quality, oftentimes investment grade rated cash flows, you were seeing yields that looked a lot like what equity returns were expected to be in the high single digits, from a total return perspective, possibly into the low double digits. And I think that sort of return profile, when you're able to do so in bond form with a defined duration and a seniority in cash flow versus what you would find in the equity markets, we thought would really stand out to investors, to retail investors and institutional investors alike. And you start to see people shift dollars towards fixed income, saying that, yeah, this premium is now enough for us to reallocate towards it. We don't have to take the bottom of the capital structure risk across our portfolio to achieve our return targets. And I think out of the gates this year, we've started to see that. Looking at at anecdotal flows across different wealth platforms, you are seeing more of a shift towards bonds or towards fixed income than you are towards equity, at least as people are looking at redeploying cash in the first quarter so far of 2023.
Yeah, that makes sense. I mean, to me, we got to a certain point, and maybe Japan illustrates that maybe you never get to that point, but bonds are yielding, they were yielding such a low amount, and fixed income felt to me like it was yielding such a low amount. I'm just like, where could this asset class really go? It feels like it's at a ceiling, and I guess it can always go a little higher, but it has to be close to a ceiling. And in hindsight, it was kind of like a simple, obvious, almost a dumb thing. And it was true. And now, with bond prices having fallen, interest rates are way higher. Well, that means the opportunity in fixed income and in structured credit, all these forms of credit, the opportunity is a lot more appealing now, right? It's just like when cap rates expand, it's like, great. As if I'm not selling this year, that's great.
Absolutely.
So this is teeing up maybe the next bull market, or the potential for outsized returns, or maybe a better way to put it is, to your argument, a better risk return profile for credit, because now it feels like credit's playing a little more offense when you're hearing about products and strategies returning 9, 10, 11, 12%. It's like, wow, this is what people used to talk about in the 70s, with fixed income. And you think back to like PIMCO and some of these kind of legendary companies, and all respect to PIMCO, but you kind of look back and go, how much of their growth was just riding this incredible wave, awesome wave, picking the right wave. That's worth a lot. But the market outlook, it also referenced. So here's my other thing. It referenced the 60-40, and you kind of flipped it and said it's the 40-60. But are we still even living in that world? I'm biased. I'm the host of the Alternative Investment Podcast. We go to all these industry conferences, and there's all this, buzz with RIAs, with family offices, with, fund managers. It's the 50-30-20 now, or, whatever their model is. So that, the idea is that the 60-40 is dead. I guess, how do you square that? Do you think it's kind of, are we in the decade of the alt now? Is there space for the 20? Is that kind of another way to state the 40-60 thesis that you guys stated?
I think so, because looking at, I guess two thoughts on that statement. One is we see the same trends, as you can imagine, as we go out and meet with existing clients or prospective clients of ours. We've seen a meaningful shift towards, or an adoption of more alternative products with everyone's portfolio. I do think when thinking about alternative products, they're ultimately investing or expressing, the same view that you're getting, whether it's in fixed income, you're either senior secured and some or potentially unsecured, but in a in a debt position within that capital structure or an equity position within that capital structure. So I think it's a different way of slicing that 40-60, if you will.
Mm-hmm.
But ultimately, I think you can map those alternative products back towards their ultimate market in which they're trying to replicate.
Understood. Okay, and I want to get to some of your funds here in just a minute, but to zoom out a little with this asset class, we're talking about structured credit, right? That's what your firm is known for. So, could you talk just a little bit, to any listeners who aren't really aware, well, what's structured credit? What is structured credit? And sort of broadly, why does it deserve a place in my portfolio if I'm a high net worth investor?
Sure. So structured credit is 6% of U.S. fixed income, or non-government guaranteed structured credit is 6% of U.S. fixed income. The agency mortgage market, which kind of gets wrapped up in it, is the second largest and second most liquid market in the world behind U.S. Treasuries. But the non-government guaranteed portion is about 6% of fixed income, and it's split relatively evenly between residential mortgage-backed securities, commercial mortgage-backed securities, asset-backed securities, and collateralized loan obligations. So it's a world of acronyms. But it offers.
And are those broadly all the things that blew up in 2008, 2009?
They are.
Okay.
They are.
Got it. Got it.
The RMBS, or the residential mortgage-backed security world, was the center of that storm. I could take you down a rabbit hole in terms of what happened from a ratings perspective and its impact on bank capital ratios. And we effectively, in a period of a few months, going into the global financial crisis, the high yield bond market was about $750 billion of outstanding securities. The RMBS market alone saw a little over $2 trillion of bonds downgraded from AAA to junk in a matter of months. So if you could imagine creating out of thin air, a high yield market that's over 3 times, a new high yield market that's over 3 times the size of the existing one, that has an incredible impact on prices and ultimately had a number of ripple-on effects that clearly have taken us decades to repair. But yes, it is largely what blew up the world. Most people know about it from the movie The Big Short, is where they've gotten most of their baseline knowledge for U.S. structured credit. But U.S. structured credit has a lot of benefits relative to other fixed income products that I think make it is the reason why you see it typically over allocated in institutional portfolios. It is often under allocated.
Well, hold on. I want to stop you there. It sounds like either that means that the smart money likes this asset class, or maybe it means the risk return profile kind of aligns more with institutional goals, or maybe both. Why would you say institutionals are kind of more overweight this class?
You tend to get compensated quite a bit more for the relative complexity of structured credit, and than let's call it corporate credit at each point in the ratings spectrum. So whether you're investing in AAAs, single A's, triple B's, double B's, you tend to always be compensated more for owning structured credit than owning similarly rated corporate credit. You also have credit enhancement, where you tend to have securities beneath you to absorb losses. So as opposed to, for example, a high yield security where the bond either pays off or it doesn't. And at which point you go into some sort of workout with the issuer, and in which you hope to recover all of your cash flow, but you may not. In structured credit, you tend to have securities underneath you that absorb those losses. So it tends to be a much slower degradation of credit than what you would see elsewhere. So I think it's the additional compensation helps a lot. And you do get paid more. You get paid a liquidity premium, which I think is really why, when you go back to kind of our impetus for launching our interval fund, which I know we'll talk about here in a little bit, part of that was that vehicle is tailor-made to capture those securities that do offer that additional liquidity premium. So it kind of magnifies what you're being compensated for comparable credit risk elsewhere in markets. And I think that's why we see institutional allocations towards it, and why we like it as an asset class.
So it's a little bit more opaque. I mean, not really, but perception of it's a little bit more opaque. It's perceived as a little bit more complex, and it has an illiquidity premium. I mean, that's pretty much a recipe for alts investing, right? That's the kind of the macro thesis on the Ivy portfolio, and to your point, these institutional investors. So I mean that does kind of sounds like my first suggestion. It's more that the smart money is saying we can put our capital to work, get a little, get a little extra return for similar occupying a similar part of that risk return profile. That's the name of the game. So now I want to talk about one of your specific funds, and I'm going to pull this up on my show notes here. And by the way, I'll make sure to also link to this fund in our show notes. But I wanted to ask about ASCIX specifically. So this is the Angel Oak Strategic Credit Fund. Could you tell us a little bit about the strategy behind this specific fund?
Sure. So this is our strategic credit fund, which is an interval fund that we launched at the end of 2017. Within it, we invest in an attempt to maximize returns across the full cycle in U.S. structured credit. We try to generate high income as a primary component of that investment strategy, and also seek as a secondary component principal appreciation.
Okay, so where does this fit in? If I'm a high net worth individual investor and I'm thinking, okay, I want to get more, maybe I'm increasing my allocation to credit, or maybe even just within my allocation to credit. I want more income. I want more potential for capital appreciation. I want the opportunity for return. Um, is this fund actively managed? How diversified is it? Would I be looking at, I guess where does this kind of a fund fit in with my overall, you know, fixed income or credit allocation? And I'll preface it with the disclaimer: neither of us are financial advisors. Insert disclaimer here, et cetera, et cetera.
So I think just to take even a step, call it one step back before I answer that specifically, and that's that I think retail investors and high net worth individuals tend to value liquidity, or tend to overvalue the liquidity of their investments. And so you see all the time, whether it's specifically within retirement accounts, people own a lot of daily liquid strategies. And so you're paying for daily liquidity, even though you can't really, as an owner of an IRA, potentially withdraw capital from that vehicle for upwards of 30 years, depending on your age and when you began investing. And so I personally think that you should be willing to lock that capital up, or get paid more for the duration of that capital, which is what institutions are so good at.
So you're basically, I think you nailed it with the IRA point. If this is in my taxable account and I have the liquidity because I might wake up tomorrow and want to buy a boat, and okay, I'll liquidate this ETF and go buy a boat, fine. If it's in my IRA, then why should I pay a liquidity tax for the next 30 years when I don't even need the liquidity? I'm choosing to pay this tax. It's silly.
Correct. And especially when making, fixed income investments, if you're looking at holding an investment in a fund for, the duration of that fund. Now, funds are open-ended and they continue to roll. But if you're thinking about making a multi-year investment, I think you should be paid for that multi-year hold period. And I think interval funds and other illiquid investments that you talk about on your podcast enable you to do that. They enable managers to hold less cash, therefore, concentrating the return stream that you're receiving in their best ideas. It protects you against other investors selling if they're not as convicted as you are, which is something that you see all the time occur in more liquid products. Also, I think interval funds are a really nice alternative relative to things like hedge funds and private equity vehicles, because you get some of the same regulatory framework that you find in open-ended and closed-ended mutual funds, in terms of limits around duration, limits around derivatives, things that kind of come out of left field, as it were, and often create permanent impairment within investment vehicles. As an end user of an interval fund, you're protected to a much greater degree from those sorts of things in an interval fund structure, as opposed to a traditional LP hedge fund like vehicle.
Yeah, so that makes sense. So essentially, the thesis with this product and this asset class is, look, with your, depending on your portfolio and your portfolio goals, if you don't need the liquidity, don't pay the liquidity tax. Or maybe to flip that and state it in a more positive way, if you can afford the illiquidity, go grab your illiquidity premium, right? I'm all about, like, my whole investment philosophy is triple net returns. And my thing is, I know I'm not the next Warren Buffett. You're not the next Warren Buffett. Nobody's the next Warren Buffett. Or if Maybe one person on earth is. Okay. But the point is, there are all sorts of easy little wins you can get just having just tax efficiency, right? Usually, just by being tax efficient, you can lock in an extra 100 bips of return every year. But it's like, that's boring. So investors are like, well, that's boring though. I want to think I can pick the next Tesla. I'm like, no, I'm pretty sure I'll take a boring win and then stack, win after win. So I think the idea that you're alluding to, and it's the IB portfolio, is if you can get extra alpha, if you look at your overall portfolio, if you take a very high net worth, ultra high net worth, family office type portfolio within every asset class, if you don't need to be liquid, you can afford to go illiquid. If you can, have high quality assets, high quality managers, that's a big if. But if you can, then you can get extra return. You can enhance returns in every single asset class in that portfolio, according to like that Yale portfolio model. Would you agree with that?
I would. I think you made a couple of good points. Which one is picking high quality managers, and I think once you do, and if you have conviction around whether it's an asset class overall, there's been a lot of work done around the compounding impact, or how the impact of you're missing out on, whether it's the top 5 days or the top 10 days or the top 25 days in markets. And I think if you're constantly as an end user trading and trying to get out in front of market moves, the likelihood that you make all of those days or are invested on all of those days that have such a large impact in the compounding effect of portfolios over time becomes quite slim. So if you can be convicted around an asset class and be convicted around a manager, I think staying invested is an incredibly important part of what you're attempting to do, which is just to maximize or create triple net returns that are one, tax efficient, and help you grow into a much more comfortable position over time. So again, back to why we think seeding liquidity is an appropriate part of certain of people's portfolios, in that if you don't need the money, if you're in a retirement account, you already have that tax efficiency and you don't have that need for liquidity, you should get paid in every way possible you can for that.
I love that. To your point, so I floated this idea on this program a couple of times. I'm gonna keep floating it probably. I can't help it. It's my brainchild for private equity fund. Okay, and so my thesis is this: illiquid private equity, private credit alternatives, they have the potential to generate higher returns. You get paid that illiquidity premium, right? So, but even if they didn't, let's just pretend we're in an alternate world where illiquid products, liquid products had the same return profile. You pointed out the behavioral mistakes. They happen over and over and over on the liquid side to 90% of investors. A huge portion of investors fall into behavioral traps. So anyway, my product idea is it's a private equity fund with a 10-year lockup. We charge, I don't know, 5-10 basis points. We take your money and we invest it in the S&P, and that's it. And we offer you no liquidity. And we force you to stay illiquid. And it's actually a value add by not even giving you the option for liquidity. We help you avoid behavioral traps. What do you think? Is this a winning idea?
Well, so one of the things that I love about at least the way that you can manage an interval fund and the way that we approach it is that you can be a counter-cyclical buyer. Hmm. So we in our product we strive to manage it unlevered in the majority of market environments. But because you're not having to manage towards daily redemptions, nor are you facing any sort of pressure on the leverage side, when you get into environments where people start selling, where people start making bad decisions, or selling for non-fundamental reasons, they're selling because they don't want to see negative returns, or they're just too nervous to continue to hold on, you can start buying. And you can do that either if you're raising capital successfully, you can do that through inflows. You can rotate within your portfolio, or you can borrow. And again, the leverage allowance within interval funds is modest. But if you're able to go out and buy an additional 25% of assets, for example, from people that are selling at, quote, the worst time to do so, you can really see an impact on returns through that counter-cyclical nature. And that's what I think is so elegant about the way that the vehicle is structured, and when managed properly, gives you the ability to take your idea and kind of build on it and be buying from those that are selling it at times when markets are under stress.
So we're doing the opposite. We're not just limiting our own behavioral mistakes. We're leveraging the behavioral mistakes of others to enhance return. And sorry, other people, if you're going to panic and a blip in the market and sell for 95 cents on the dollar and we can buy at a discount, we're going to do it. Right. So it sounds like this fund is very actively managed. I guess, could you talk about the management approach and, the investment selection within the fund?
Sure. So for all of the products that we manage on the liquid side, we're investment committee driven. We have an investment committee that consists of the senior portfolio managers across the firm, some combination of them. We each come from a different product specialty, whether that's residential mortgage credit or commercial mortgage credit or corporates or CIO, for example. And what we attempt to do in investment committee is look at the macro environment and identify asset classes that have sustainable fundamentals. And we're big believers in giving ourselves a wide margin to be wrong. Meaning that we can't appropriately predict pandemics or Russia's invasion of Ukraine and its impact on the world overall. So we don't want to have an investment thesis that rests on a razor's edge of having to be correct or break one direction only for it to be successful. So for us over the past several years, but we've become increasingly more convicted and raised our allocation to it across the platform. U.S. housing and specifically U.S. mortgage credit has really exhibited that, where you have a number of long-term sustainable fundamental trends that we think will result in housing being quite stable and in mortgage credit performing very well on a fundamental basis looking forward several years. And if we can identify those parts of the market that offer us outsized returns backed by those fundamentals, that tends to be where we deploy capital. If it's on the daily liquid side, we're going to be more up the capital structure with a wider variety of or larger diversification of assets into which we're investing. If it's in the interval fund, we can invest at the point of the capital structure, whether that's senior, mezzanine, or junior, that we think maximizes our return potential in light of that kind of bandwidth to be wrong that we seek, and express a more concentrated view there. Because again, we're less, we don't have to manage towards the daily ins and outs that you see in a traditional mutual fund.
I mean, it almost sounds to me, it's probably a bad analogy or comparison, but almost like a macro hedge fund or something where you trust the manager and you want to give them the freedom to sort of take advantage of inefficiencies and, not total freedom. As you point out, there's the regulatory framework to kind of constrain it somewhat. But then within that, to sort of trust your investment committee, it sounds like you're identifying big trends and then, you're creative and flexible enough that you can take advantage of the best opportunity rather than just, we're going to buy this one tiny little asset segment over and over and over because we have to, because that's our mandate.
And what we tell investors and what we've demonstrated over our life as a firm is that we're not going to stray, from our core competency. You're not going to wake up and find a big currency trade or a big emerging markets trade, however cheap those may be, a big municipal bond trade. Those markets can exist on their own, and we're not 100% of anybody's fixed income portfolio. So we're just a component within it, whether it's fixed income or alts portfolio. And so we want to be delivering, a return off of a reliable set of assumptions from that investor. And that's that we're going to be in U.S. structured credit and in corporate credit, but we're going to stay domestic and we're going to stay focused on our core competency and not go too far afield. So it's not a true unconstrained fund in that regard, but we are going to move within our sandbox and and identify the best opportunities within it.
Yeah, honestly, zooming out, that's where I think a lot of the best thinking happens, is within constraints, right? It's like, maybe, I don't know, it's not a paradox exactly, but you're talking about, you stay in your core competency, you stay in that mandate, but then you have some freedom within that. And I mean, honestly, I think that's where a lot of professionals, a lot of creative thinkers do their best work, is not totally unconstrained, but given the set of constraints, where's the value right now? And I think it's interesting that this product and this strategy is in an interval fund wrapper, because it seems like this kind of a strategy, this asset class, could be in several different wrapper types, right? So, why the interval fund? Why the intermittent liquidity? What is it about this product structure that really, is optimized for the strategy within the fund?
Well, as I mentioned when I was walking through U.S. structured credit to begin with, is that structured credit is what it sounds like. It is structured. There are a number of what are called tranches or bonds that are issued off of each of the collateral pools, and those tranches have differing sizes, differing ratings, differing seniorities versus one another. And clearly, the typically the further up the capital structure you are, or the higher quality credit you're in, those tranches are larger, broader sponsored, more liquid. But you may, from our perspective, you may not see losses occurring anywhere in the investment grade portion of the capital structure, and you may have to go all the way down near the bottom of the capital structure to identify securities towards the equity or single B, where you start to see losses tick up in a bear case scenario. And so in a daily liquid strategy, you see a lot of structured credit. We manage a lot of structured credit in daily liquid, but it tends to have a more senior part of the capital structure skew to it. Whereas in the interval fund, we can focus on those securities where, again, we're seeking to kind of maximize the returns that we can generate. So, perhaps it's being a bond above where we see losses in a bear case outcome. And that may be further down the capital structure than we'd be comfortable doing in concentrated format in a daily liquid vehicle.
Got it. So with this interval fund, it's intermittent liquidity, right? It's not totally illiquid. It's not totally liquid. How does it work from a practical standpoint? Is it a monthly liquidity option? Is it quarterly?
Sure. So we price daily. So an NAV comes out every day. It is available for purchase daily. Redemptions are done quarterly. The SEC minimum is a 5% fund level gate. So 5% of assets must be able to be redeemed at any given quarter. That's actually voted on by the fund's board of directors. So that can be 5, it can be 10. And you can see that number kind of accordion up as investor demand may, but and as market conditions would allow. Typically, you may have an environment where you're always trying to do what's the best for fund investors, where the market is distressed, and you are generating. I think one of the unique things about structured credit is that you're generating quite a bit of cash flow on a monthly basis through return of principal from the securities that you hold. So oftentimes we can generate organically without having to sell a single security ample cash flow to pay the.
Well, and is there like an overall blended yield? Is that published? So I'm also it's throwing off income left and right, right? But I guess the yield is going. Does that just get paid directly to the investors, or how does the yield play into this redemption?
The yield gets paid as a dividend, just as you would see in an open-ended or closed-end mutual fund.
Got it. So got it. And then as far as the leverage goes, it sounds like that's fairly tightly regulated, but you have the options. You don't have to use the leverage, but you can. Can
Correct.
that be used for redemptions at all, or is that only
You could lever up to pay out redemptions. You could borrow to do that. That's philosophically something that it just depends on the market opportunity set that is available at the time. Clearly, if the fund is shrinking, levering into it's going to increase the overall leverage of the strategy. Now, it may be an environment where you would rather rebuy your portfolio if you didn't have adequate cash to meet those redemptions, and as a result, you would choose to lever to meet them. To date, we've not made that decision within our strategy, but it is something that you could absolutely do.
Well, I think it's good though. I think with interval funds, it's good when there's a little bit of flexibility on the other side, where not total freedom, not totally free of constraints, but you have a little bit of room to react to market conditions and pressure valve releases or whatever you want to call it. So I think we have a pretty good feel for the product. And thank you for walking us through that, because I think a lot of investors maybe haven't invested in interval funds. And they're gaining traction for a reason, right? Between this world of liquid investments and totally illiquid private equity, 5, 7, 10-year hold stuff. They're a popular wrapper for a reason. They're gaining traction for a reason. But I want to zoom out, talk a little bit more about the macro picture before we run out of time. So you mentioned, that your team, you anticipate, obviously we're seeing some disinflation, and you even said that we may touch 2 briefly, but then, that might reverse. We're not going to stay at 2% inflation. So there may be higher sustained inflation going forward. We're also coming off a pretty bad year for stocks and bonds last year, right? You see that reversing for this year? Do you see this year overall being bullish for fixed income and for credit?
I do. I do. I think just the natural calming down of volatility. I mean, as we started to move off of the zero bound, the aggressive nature by which the Fed moved to tackle inflation just put, I think, a tremendous amount of uncertainty and volatility into the market. And just the calming down of that alone as we reach or near peak policy here in the first part of the year, I think is very constructive for asset returns, both fixed income and equity in the short term.
And what about, the recession? Because to be honestly, the whole last 3 years, they've been so odd. They really have. And there's so many negative things going on in the economy. But at the same time, I feel like there's a group of investors, professionals, maybe even myself among them at times. It's almost like we're rooting for a recession. And then it sort of feels like maybe it's not going to come. This may be a kind of a muddle through, I hate to use the phrase soft landing. That may be what this is. Like, don't get me wrong. I don't know that the Fed knows what they're doing. I don't know that policymakers, I see mistakes being made left and right, supply chains, all of it. Believe me, I can list 100 mistakes, but nevertheless, it kind of seems like things are recovering and we might muddle through. So do you think we're in a recession? Are we facing one, or is there a chance that we're going to kind of squeeze by somehow?
Yeah, from an investment committee perspective, our base case remains that we will get a recession towards the end of this year. How much of that feels like one versus how much of it is more data driven, I think is still to be determined. I don't envy those in a policy seat having to, from a central bank perspective, having to navigate through this environment. I do think that we will get numbers that flash recession. We think it will give Chairman Powell and the FOMC the opportunity to pause, potentially enabling inflation to start to tick back up. I don't think we're heading towards a particularly deep recession, one way or the other. To your point, this would have to go down as the most projected and perhaps televised recession of all time as we're heading into it. So I think there's a lot of uncertainty around what's going to happen. Typically, if everybody's thinking one thing, it's not a bad idea to take the other side of it. But everything you look at from a data perspective seems to point to us rolling into one at the end of this year.
And your investment committee and how you're predicting that, are using the technical, are we still using the technical definition from like 3 years ago when a recession was defined as 2 consecutive quarters of negative GDP growth?
Now back to the comment around will it be data driven or will we actually feel it? I think we do have to use the technical definition, at least as we're talking about it. Whether that leads to to again some of the same pain and suffering people have experienced in prior ones, we'll see. But yes,
I'm sorry, but folks, we need technical definitions. If economics is supposed to be some sort of science, if this is supposed to be data driven, we need to have common definitions. I'll get off my soapbox in a second, but then those also have to, decade from decade, we need to have this consistent definition of recession. So I'm with you. Let's stick with that definition. And to your point, though, that not every recession is going to look or feel the same. Right. And so, folks can be feeling economic pain, but not technically in a recession, or the economy could technically be in a recession, but the labor market could be very strong, right? These things that they don't always look and behave exactly like the last one, right?
Right. I think everybody, is guilty of fighting the last war, as it were. And, I think you've seen that in a lot of the narrative around housing. I mean, every day I open up, whether it's the Wall Street Journal or Bloomberg or other publications, to a negative headline on housing. As we dig in, I don't think it computes with what's really going on in U.S. housing, but it is. I think each one will be unique. This will not be like the last one. I think we can all be certain of that, but that's probably about the only thing we can be certain of.
I think we got to end on that one, Colin. It's not going to be like the last one. I think I got to give my stamp of approval on that statement. And that being said, thank you so much for coming on the show, talking about structured credit, your funds, your offerings, just the macro picture, really insightful stuff. Where can our audience of high net worth investors and advisors go to learn more about Angel Oak Capital Advisors and your investment offerings?
Sure. AngelOakCapital.com is a great place to start for all of that.
Absolutely. And I'll be sure, I'm going to link not only to the website and Colin and Angel Oak's LinkedIn page, but I also want to link to the credit fund and because I want in the research, because I want our listeners to be able to access some of this research because it's really good. And I just like the framing of it. It really kind of pulled me in and, to the story. I think sometimes writing this kind of content or research, you kind of have to put it into a story to make it digestible for a guy like me to really pull me in. And you guys did really good job on that. So those show notes are always available at altsdb.com/podcast, and they'll be published as soon as you're listening to this. Colin, thanks again for joining the show today.
Thanks so much, Andy.